Hey guys, welcome to the channel. My name is Max Convexity. I have a good one for you tonight. There's a lot of math involved, so put on your crash helmets. We'll get right into the middle of it. Check out this chart up here of Coinbase versus Coney. Coney's a high yield covered call fund from YieldMax, of course. Look at Coney, went from $19.89 to $8.99 in the same time that its parent asset, Coinbase, went up from 245 to 391. What gives? The name of this video is Why is Max a YieldMax Karen? Now, I've been accused before of being a high yield panic, and I guess that's a fair criticism. After all, I sincerely believe that NAV stability is a myth, and I'm going to prove it to you. There's no such thing as stable NAV in high yield ETFs. Some ETFs are more stable than others. The best you can strive for is relative NAV stability. We're also going to look at how the NAV of these ETFs moves with the market and doesn't move, like you saw in that example of Coinbase, goes the other way of the market. Now, let me say, I love the idea of these funds, and you guys know that. At the same time, I understand exactly how they work. Knowing what I'm invested in and knowing how it affects my total returns, it's vitally important to me. All of the other influencers talk about the benefits that YieldMax can offer. But today I'm going to discuss how YieldMax generates a yield and creates NAV return or upside. You have to first understand the high yield equation. Now, this is something I came up with, the high yield math equation. I came up with it to help folks. The equation is TR equals NV plus DR. Total return equals NAV return plus dividend return. If we have any two of those numbers, we can solve for the third. I'll show you examples in a bit. What's the number one concern about high yield ETFs? Hint, some call it NAV erosion. Most call it NAV erosion. What people usually mean when they're talking about erosion is that their ETF, their high yield ETF, doesn't go up as fast as the market or the underlying security does. This is an erosion. And more importantly, what we're going to talk about tonight, it's directly caused by the dividend. The higher the amount of the dividend, the worse that the NAV does. Remember, the NAV's price is reduced by the amount of the dividend on ex-dividend day. That's why you get up in the morning when you're getting paid on your dividend and your high yield stock is down $1 or $2. But then you have, and a day or two later, you have whatever it was down, you get that much in your brokerage account. If a high yield ETF pays 5% dividend every month, like some of them do, this adds up to about a 60% dividend for the year. So that 60% comes out of the NAV, and that's missing from the NAV. You think of it, in a high yield dividend that pays 5% a month, you're pretty much starting the year 60% in the hole. A feature of covered calls is that they pay distributions from the sold option contracts. When you sell an option has time value in its price. When the option expires, it has no time value left in the price. Since YieldMax is selling time value, they profit off this phenomenon. This has a benefit and a drawback. Remember, there's two sides to every coin. The benefit is higher distributions can provide more income to live off of. The other side to the coin is higher distributions impede the NAV's upside. The good news is the time decay captured by the ETF creates cash for the distributions. Everyone wants a large distribution, right? Here's the thing to understand. A big distribution is what causes NAV underperformance in a bullish market. The other side of that coin is a big distribution also creates a big downside buffer, which is good for total return in bearish markets. Now, the big distribution won't keep you from losing money in a bearish market. Typically, high yield ETFs do outperform the parent asset in a down market, though. The other side of that coin is typically covered call strategies underperform the parent asset generally, but especially in bullish markets. Covered calls aren't magic. They are a tactic that can be very effective in retirement planning. If you're ultra concerned about NAV depletion, erosion, whatever you want to call it, you don't have to watch the rest of this video if you don't want to. Just choose the ETF. Just choose ETFs with lower distributions. Other things being equal, the fund with the lower dividend payment will always perform better on the way up in a bullish market compared to the fund with the higher distribution. This is what most newbies conflate with NAV erosion. However, a lot of us have these ETFs with high dividends. So I want to talk about these. I want to go in depth a little bit with these. If you're ready to do some math, let's take a look at this. Now, first, really quick, we're going to look at a covered call on Coinbase. So this is done at the end of the day on Friday. Coinbase was trading at 391.60. Okay, and that's where this white line is. And we went out of the money. That's how covered calls are done. They're usually done out of the money, some distance. So in this case, we chose the 415 strike call, and we sell that call. So we could get $685 for this on the close on Friday. Okay, well, $685 equals 1.8%. Max loss is $38,000. $695 is 1.8% of $38,000. Now, what does that 1.8% do? Well, that 1.8% creates a buffer for you. It means that you don't lose money. Your high yield ETFs NAV doesn't lose money until the market's down at least 1.8%. That's the buffer. So you get a 1.8% head start on the parent asset in a down market. And that's why these high yield funds generally outperform, covered calls generally outperform in a down market. Now, they don't keep you from losing money. You still lose money, just not as fast as the parent asset does. The other side of it is, and this is how your NAV goes up. Your NAV goes up, and this expires in a week. Your NAV goes up. Let's say by the end of the week, the price of Coinbase is at, say it's at 420. Okay. Well, your high yield ETF will make the $695 it received, the 1.8%, plus its NAV of the high yield ETF will also go up 6.1%. The NAV goes up 1-for-1 with the market until you get to the sold strike. So you have a trade here that you can make 6% plus 1.8% in 1 week. That's 7.8%. That's not too bad. Only problem is you make 7.8% also if Coinbase goes up 20% or 30%. You're capped out. We all kind of understand how that works. That's a real quick, I believe, that's a real quick update on covered calls. But now let's get in the nitty gritty of it. So we all have these high yield funds. I do. I mean, I have all. I mean, and I have all of them. I've had Misty before, and I still have a few shares of Misty. All right. So let's look at Coney from YieldMax and compare it to Coinbase, which is the underline, of course. Now we're going to refer to this chart at the top of the page, and here's the numbers we're using. This is going back a calendar year. Okay, so let's just go through these calculations. First, we have to compute the NAV return and the dividend return for Coinbase. So for the past year, Coinbase went from $245 to $391. That's a difference of 146. I'm leaving off the cents just to make it easier. So next, we take that 146 and we divide it by the starting value, which was $245 to get the NAV return. That comes out to about 59%. Okay, so 59% is Coinbase's NAV return. Now remember the high yield math. Total return equals NAV return plus dividend return. At this point, we have total return equals 59% plus dividend return. So next we need to figure out the dividend return for Coinbase. Well, Coinbase doesn't pay a dividend, so that's easy. We just put a 0 there. So here's our formula. Total return equals 59% plus 0%. So, and sure enough, total return for the year for Coinbase was 59.86. The 0.86 were those pennies. And this ties with what dividend calculator says. So, but now let's do the same thing for Coney. Now, this is going to be a little bit more difficult because Coney pays a dividend. And there's going to be one more step involved. First, Coney started the year at $19.80 and is now, as of Friday, at $8.99. That equals $10 $10.81 negative, negative 1081. So what is negative 1081 divided by $19.80, which was the starting price for the year or a year ago? That comes out to negative 56. And this is a negative number, remember, because Coney lost 56% in NAV. Okay, so the total return equals, well, let's do the formula. Total return, we don't know what that is yet, equals negative 56 plus dividend return. Okay, next we need to figure out the dividend payment as a percentage of the initial investment. Now, Coney paid a gigantic dividend, of course, $12.16 on an initial investment of $19.80. This equals almost 62%. So now we have a total return of minus 56 plus, we have to plus by the dividend return, which is 62. So when we have minus 56 and plus 62, we solve it and we get about 5 or 6%. And that was the actual total return for Coney last year. It actually came to 6.79%. Okay, so now let me show you, we're going to talk about the stable NAV rules. Now, this is a more advanced concept, but and this is a rule of thumb. So stable NAV is a misnomer. There's no such thing in high yield ETFs. So like I said, the best you can hope for is relative NAV stability, and that's good enough, in my opinion. Here's the stable NAV rule of thumb. Multiply your high yield dividend yield by 2 or 3. That number that you get is the amount of total return you need to get out of the parent asset to not watch your high yields NAV go down constantly. So if you want to buy a high yield ETF with a 50% yield, you're betting on the parent asset to have 100 to 150% total return. That's the rule of thumb, 2 to 3 times. So if you have a high yield ETF and the parent asset goes sideways, you will lose the entire amount of the yield in the price of the NAV. An ETF with a 50% dividend will be down about 50% in a sideways market, maybe a little bit less, but it'll be down 40 to 50%. In a sideways market, the option strategy is not able to catch any NAV upside because the NAV doesn't go up, but they still pay a dividend. So the amount of the dividend is around what the NAV will be down. It's just math. I'm going to show you some examples of this. Now, this is a good reason not to be on margin. And we're going to talk about margin in a second, but let's look at some examples of this. I made a little spreadsheet, and what we're going to do is we're going to compare YieldMax with Curve, and we're going to look at 3 different underlines. Now, Curve is similar to YieldMax, except generally their products that are based on the same underlying have about half the dividend. Okay. So it's a good way for us to compare it to. So we should expect Curve to get better NAV upside. Okay, and we'll see kind of how that bears out and if that's true. So let's just start here with TSLP. Now TSLP started the year. This is the last not calendar year, but a year ago. This is from last July 26 to this July 26. Okay. Beginning price was $23. TSLP was at $23 last July. Now it's at $19. Okay, well they've lost 15% in NAV. Okay, but they paid a 12-month dividend. They paid a dividend the last 12 months of $7.95 or 34%. So their dividend was a 34% yield. So now we can figure out their total return. NAV was down 15%. Dividend return was 34%. So negative 15 plus 34%. The high yield equation, and it comes out to 19.28. And that ties with the total return for TSLP for the year. They made a 19% total return. Nice job. TSLP does a great job. Now we're going to turn our attention to TSLY. Now look at the yield. And it's true to form. TSLY pays about twice what TSLP does. Okay, so let's kind of see how TSLY's year went. Well, TSLY started the year at $15.11. They ended the year at right now they're at $7.75. That is a NAV return of negative 48%. Okay, but don't forget the dividend. They paid $9 worth of dividends, which comes to 65, almost 66%. So we can add these together. The equation is total return equals NAV return plus dividend return. So NAV returns -48 plus dividend return +66. That equals about 70% total return, and that's what Tesla got for the year. That's not bad. That's not bad at all. Now, Tesla's NAV return was not good, but their total return was also a little bit lower than TSLP's. But and then just for comparison purposes, let's just look at Tesla real quick. Tesla's NAV was up 43% for the year, but they paid no dividend. Okay, so we could put the high yield equation on stocks also. Total return equals NAV return plus dividend return. So dividend return 0, NAV returns 43, so that's their total return. Stocks are easy to figure out. Okay, but now let's talk about the stable NAV estimation formula. So what do we know about Curve? It paid a 34% yield. So based on that number, we need 2 to 3 times as much to not suffer any type of NAV depletion. So I put those numbers over here. 34 times 2 is 69, and times 3 is 103. Well, anyway, that's the upside we need out of the parent asset. So let's see if we got that much upside. Tesla's upside was just 43%. So no, there wasn't enough upside available in Tesla to pay a 34% yield and not have TSLP suffer any erosion. Now they're only down 15%. They didn't do too bad, but Tesla didn't perform well enough for TSLP to have a stable NAV. Okay. Now TSLY, on the other hand, their NAV is a mess. But let's look at the reason for that. So let's look at the stable NAV estimation formula. So we take Tesla's yield, which is 65%, meaning they would need to get between 131 to 197% out of Tesla. Tesla would have to be up 131 to 197 for them to have stable NAV. And you can see Tesla, didn't even make as much as they paid out. So of course their NAV's a disaster. Their NAV lost half its value. Okay, now it doesn't make it a bad investment. They still did a total return of 17% for the year, and you got a 65% dividend along the way. But it came out of the NAV, and you could see it right there. It's just the way it works. Okay, so now let's go down to MSFY and MSFO. This is a little better news. This is definitely better news. So let's look at MSFY. This is from Curve. Now, their beginning NAV was 26, almost 27, and their ending NAV was just over 27. They were up 2% for the year on NAV. Now, I'm going to call that stable NAV. Great job. Now, what had to happen for them to get stable NAV? Well, first, let's look at the dividend. The dividend was only $3.19, which is only 12%. But the good thing about only paying a 12% dividend is you don't have to have as much upside from the parent to not suffer any NAV depletion. We'll look at that in a second, but first let's look at the high yield formula. So MSFY's NAV return was 2.48, yield was 12.01. You add those together and you get the total return, and that works out almost to the penny. All right, then on MSFO, and this one is from YieldMax. So this one is going to pay a higher yield. Let's just compare the yields real fast. The yield on the Curve product was 12. The yield on this YieldMax product was 27. Okay, well, let's look at the YieldMax product's NAV. The beginning price was 20. The ending price was 18 or so. It's about down 12.65%. So we'll put that into the formula, negative 12.65. But we have to add in this dividend of 27.31. We add those two together, we get 14.66 for our high yield equation, which is exactly what the total return for the year was. Good total return. NAV, not so good. NAV lost 12%. So the NAV's not stable in this product, but it was in the Curve product. Why is that? Well, one thing is because Curve paid a lower yield. But let's look at the NAV stability formula. So the NAV stability formula says that the yield of the child asset, the high yield asset, in this case, the Curve MSFY, 12%. So we need to double that or triple that. And I put those over here. We're looking for 24 to 36% to get a stable NAV. Now, It's just a rule of thumb. And let's look over here. Microsoft itself actually got a 20% NAV upside. So these guys are pretty efficient. These guys were able to get just 73% extra over their yield. So it's 173% total. And that was able to create a stable NAV for Curve. Great job. Okay, but now let's look at MSFO. Now, MSFO, on the other hand, had a 27% yield. So we'll do the rule of thumb. 2 to 3 times 27% is 54 to 81%. Well, Microsoft didn't go up enough to support that kind of dividend. So that's why the NAV's down, of course. Like I say, and it's not all bad news. It was a good total return, but if you're ultra concerned about NAV, you would choose the lower yielding one. It's just the way it works. It's just math. The yield is a tax on the upside. We can also look at Microsoft just to confirm. Microsoft had 20% NAV upside, and Microsoft does pay a small dividend, about 3/4 of a point, but we add 20 plus 3/4 of a point, and we get a 21% total return for Microsoft. Microsoft did a great job, like I say, and that was enough to support a 12% dividend. But that return was not enough to support a 27% dividend, not even close. Okay, so this is the final example. I know you guys will be glad, but let's look. This is a good one too, and this is good news. And let's just check it out. So NFLP, the Curve product, actually got a ton of upside. Beginning price for the year was 29%. They closed at 36 the other day, almost 37. That's like 24% NAV upside. Great job, NFLP. Just getting all that NAV upside. Now let's look. They yielded 25%, whereas the YieldMax product yielded about twice as much, true to form. But anyway, they yielded 25%, so that's great. Well, let's do the high yield equation. 23% plus 25% equals 49.13%, which was almost to the penny exactly how much total return they got. So the formula worked out perfect in that case, and it usually does. Now let's check out InFly. Now InFly is the YieldMax product, and this one has twice as much yield. Instead of 25, it pays 52. Okay, but let's check out InFly's NAV. Now look at this. InFly's NAV was at 1656 last year and is at 1696 this year. That's really impressive, especially considering they paid a 52% dividend along the way. So let's look at that. Now we're going to talk NAV stability. So the NAV stability equation for NFLP needs 51 to 77% NAV out of Netflix to support the 12% payment, or I'm sorry, the 25.84% payment. And they got more than enough. They got more than triple the upside. Netflix did more than enough to support a 25% dividend all day long. In fact, they even got some growth out of their NAV. That's great because Netflix did that well. Okay, now InFly, on the other hand, is kind of right on the borderline because they, at a 52% yield, according to my rule of thumb, they need somewhere between 100 and 150% out of the parent asset to support that dividend. Well, good news. They got about 90% out of the parent asset. So InFly was the most efficient one on the whole thing as far as, over the past year. But still, to pay that 52% dividend and to not suffer, to have the stable NAV that everyone desires, it didn't have anything to do with the high yield fund. It was all because of Netflix doing a great job. Netflix being up nearly 90% was able to support a 52% dividend through the year without killing the NAV. Let's say this, my rule of thumb on needing 100 to 200% may be a little bit on the conservative side. As we saw from InFly, it just needed 66% extra. And as we saw on MSFY, it just needed 73% extra. It didn't need the extra 100%. It didn't need to quite double, but lots of times they do. I run these tests all the time, and some, depending on what the underlying is and how volatile it is, sometimes they need up to 3 times. But anyway, just what I would do is if I'm thinking about buying a fund and it has 100% yield, in my mind, I'm telling myself, okay, the underlying to this fund needs to be up 200 to maybe even 300% if I expect a stable NAV. Remember, the stable NAV is just a rule of thumb. If you have but here's the other thing that I haven't mentioned yet. If you have a high yield ETF and the parent asset goes sideways, in other words, makes 0% over the course of a year, how do you think your high yield ETF is going to do? You're going to lose the entire amount of the yield in the price of your NAV. So an ETF that pays a 50% dividend, but the parent asset goes straight sideways for the year. Okay, well, they still get the 50% dividend, and that creates a buffer, and it does some good stuff, but they're basically going to be down 50% because they aren't going to be able to catch any NAV upside if they don't get any NAV upside. They might not lose quite 50%, but they'll lose every bit of 40%. You can count on losing a lot of NAV in a sideways market. I would say you could basically count on losing whatever the yield was. Now, this is a good reason right there. A sideways market is a good reason not to be on margin, in my opinion. It doesn't even necessarily take a crash in some of these super high yielding ones. Remember, your maintenance margin amount is calculated with the NAV of the high yield ETF. If your high yield ETF's NAV drops 50% because the market goes sideways, but yet your fund was still paying you dividends along the way, and it comes out of the NAV, so your NAV decreases. If it goes sideways for 2 years, you're going to get a margin call, especially if you're living off the dividends instead of paying down margin debt. Money can't be two places at once. If you use your 50% yield to pay down your margin balance, good for you. You may not get a margin call in the previous example, but your NAV is still going to be down 50%. If you're on margin and you're trying to live off of the dividends at the same time, that's great as long as the market keeps going up. If the market goes down, for sure, if it goes down or sideways for an extended period, good luck paying your margin down and not having constant margin calls. Now, I know I'm going to get tons of comments like this. I bet some of you guys are already typing. I'm on margin. I have high yield ETFs, and I pay down my margin every month and still have money to live off of. And that's great. I'm super glad for you. But do you realize the only reason this has been working for you is not because you've chosen ETFs with stable NAV. There's no such thing. It's because the market has gone straight up for the past 2 or 3 years. These funds haven't been around that long. Those super high yield funds have only been around for 2 or 3 years. The past 2 or 3 years, we've barely had a down market. We got 5 or 6 weeks in March and April, but then we V-bottomed and shot right back up. We've been ripping off the 2022 lows. I'm telling you, the only reason you've been getting away with it so far is because we barely had a dip since late 2022. The dips that we have had been shallow and quick. As long as the market keeps doing this, you'll be fine. You'll probably continue to get away with it. What do you think will happen if we hit a 2022 where the market doesn't bounce back right away? Look at XYLG, which is one of the safer and lower paying high yield ETFs available. And in 2022, its NAV went from 31 to 25. It lost a ton of NAV. It was down 20% for the year. And this is XYLG. Now, they still got that 12% dividend, but they weren't able to catch any upside from the covered call strategy because the market didn't give them any upside. Heck, the SPY went from 477 to 382. Now, what's worse is even if you go out 2 years, it took the SPY 2 years to get its head back above water. Well, XYLG was still underwater a little bit. You started at 31, nearly 32, and you were at 28. I mean, what is that? That's about 10%. I mean, and that's after 2 years. And this isn't even one of the super high paying ones. Had this been one of the ones that paid 50%, you're going to get margin called. That's all there is to it. So why'd I own these if they're so bad? Well, I allocate only a small percentage of my overall portfolio. I don't use margin. If you do use margin, that's fine. I'm not telling you not to use margin. You do you. Just be aware of what kind of damage a prolonged downturn could do to a margin balance. So here's some of my best practices. So I say don't allocate more than 20% of your overall portfolio to these high yielders. You've heard about the 60-40. It's 60 growth, 40 yielding assets. Usually it's bonds, but it can be other stuff. So I say 60-20-20. In other words, you could break off, in my opinion, without too much danger 20% for these high yield ETFs. I would keep the rest in growth. But with only 20% or less is better, actually. But with only 20% or less and no margin, I can hold these for a long period of time indefinitely without too much worry. I'm aware of the lack of NAV upside. I'm not that concerned about it because 80%, 90% of my portfolio is in growth, and that will get plenty of NAV upside. I'm not counting on the NAV upside from these because I'm not overloaded on them. The less is even better. If you don't have to use 20%. If 10% of your overall net worth will bring in enough money, if you can allocate 10% to high yielders, and that brings enough money to live off of, all the much better, because that leaves 90% for growth and for bonds or whatever else you want, real estate. If you're fortunate enough to be able to use 5% of these or 2% of these, that's great. The less is more. You don't use any more of these than you need, than the money you need. I'm not concerned because most of my portfolio is in growth. So remember, these aren't magic. They usually underperform against the parent asset in a bull market, but they usually outperform on a total return basis in a down market. That's the other side of the coin. However, remember, in a down market, you're going to take it on the chin as far as NAV goes. NAV's one of the factors in your margin balance. So my advice to you would be get your margin balance paid down before the next downturn hits, and you'll be golden. You'll be glad you did it. All right, guys. Thank you for watching. I appreciate it, and you have a wonderful day. See you later.